So I want to ask you if things are, in fact, turning dark. Are they going to go black, or is there a pony in this manure someplace? Let me begin with Don Luskin.
There's definitely a pony. Stocks are so cheap. Pessimism is so thick. You don't even need the knife to cut it. You need a flamethrower or a chainsaw. You got to buy them here. But longer term, you got to look for an exit because higher taxes are coming under President Obama. It's going to be terrible.
How long is long term?
We're gonna have to discuss that when it comes, Larry. Fortunately, you get to do this show every day, but probably sometime between now and the end of the year.
First, we had the housing collapse. Then we had the Wall Street rose.
Which recession is this? Remind me again. Which
this is the one that started late last year.
I haven't seen that. Don Luskin, here we go
wait
again.
a minute. Wait a minute.
The third part of the recession, Don Luskin, real quick. The third part of what recession?
We're not in a recession, at least not yet. You can't see any economic indicators at a recession level. And besides, you know something, Gary Schilling, I got to tell you, it's one thing to always say there's a recession, and another thing to know what to do about it.
Because then you always
wait a second, let me finish the sentence. Gary, let me finish the sentence.
And they've been going down.
You know,
and we had the peak in stocks last October, and they're continuing to go down.
In mid-March,
and we're in a bear market.
In mid-March, when things looked the blackest, and you said the thing that was going to go up was Treasury bonds, you were absolutely wrong. The financial sector has performed better since then than Treasury bonds. Right. So what do you tell us to do, Gary Schilling?
Well, what are you telling us? You've been telling us to be bullish.
Do we lose money in Treasury
I'm looking
bonds?
at reality. I'm not
advice?
looking at hope.
Real quick, what's your play here? I think the core rate is starting to move. I want to bring in Don Luskin, heaven forbid, as a Bill Ford substitute for the hard money king dollar position. Go ahead, Don. You heard Joe Livornia. Please respond.
Look, it's really simple. Inflation is everywhere and always a monetary phenomenon. So when the Fed is too easy for too long, which it's been in one flavor or another since 2003, you're going to see a falling exchange rate of the dollar, rising commodity prices, rising statistical inflation. It's destiny. You know, the official inflation numbers are lagging. They lag by anywhere from 9 to 18 months. So we haven't even begun to see in those numbers the slashing of interest rates that the Fed began last September. Now, if they start raising interest rates now, that's all to the good. That'll keep the worst case from happening. But we cannot avoid, no matter what. Bernanke tomorrow could set interest rates to 100%, and we are still going to live with that pipelined inflation that he started creating last September when he first started cutting rates.
I just want to add to what Don is saying. I don't look at it that way. I think that inflation is a lagging indicator, and what we're seeing recently, in some sense, was actually decent growth last year. And I think basically recessionary type of growth this year into next year will bring about lower inflation in late 09. And what I think has to happen is the Fed has to have enough courage to really look, Larry.
The world economy, for a variety of reasons, particularly some of the bigger countries around the world, are going to see slower growth over the next several quarters, and that won't translate into an anti-inflationary benefits right away. But I think as the world economy slows...
What evidence is there that growth causes inflation or that slow growth causes less inflation?
I think it will mean that we won't be at such high levels of capacity utilization.
That's right. Look, Larry, when you have inflation,
Time out, gentlemen. It's so great, Don Luskin, about this. When the Keynesians turn monetarist, you know you have a problem. When the supply-siders stay with the gold and the dollar, and in this case oil prices, I think it tells a story. But the most interesting thing is rising inflation is causing rising unemployment, Don, and that throws a monkey wrench into those Keynesian/Joe Livornia
Yeah, but Larry,
textbooks.
Gold prices are down from their peak.
I love it when the Keynesians, like Ben Bernanke himself, say the Phillips curve is flat. That's just code for the Phillips curve doesn't exist.
I don't take us out. You heard Gary Schilling. He said we're only halfway there on the house price drops. Your thought, Don?
Housing affordability is better than at any other time since the data began in 1972. So we're a lot further than halfway there. 3 of the 4 aces have been dealt out of this deck. And by the way, on forward earnings, 5 out of the 10 S&P sectors are at all-time high forward earnings as we speak. We're not seeing any deterioration whatsoever in forward earnings.
So you think that second quarter earnings could be better than expected?
Could. They will be. Absolutely.
And the stock market will still go down because what's in front of you is more deterioration.
But there hasn't been any deterioration outside the financials.
You just had a 25%. You just had a 25% drop in demand for autos and light trucks in the month of June, which is supposed to be the best-selling season. When are you going to recognize?
So short the autos and the light trucks. Does that mean you're short Google?
Let's take out housing, let's take out autos, and let's take out high-end retail sales. And while you're at it, the only thing that's working is agriculture and exports, which, as last I checked, was only 15% of the economy.
The only thing that's working?
The other 70%, you're walking past the graveyard. That's an incorrect way to analyze it.
So how come technology sector earnings are at all-time highs? That's not working?
What, is tech your favorite sector, Don Luskin?
Tech's a great sector right here.
The truth is somewhere in between both your positions.
Ahead,
it's not going to be great.
Just remember, Don, you got to knock down house prices. You got to knock down SUV prices in order to sell them. And that's one of the reasons why I got, because people do not have the money to spend the fuel to get to the outer suburbs where the houses have been built.
I'll remember
so just
that,
like
Gary.
You
I'll take another 7% loss in Treasury bonds. I'll remember that.
Many thanks.